Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at AST SpaceMobile.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And real quick before we jump into the weeds today, we do want to mention StockOracle.
Right.
There is a 14-day trial link right down in the description if you want to check it out. Just a quick disclosure, we are an affiliate, so we do earn a small commission if you sign up, which helps support the deep dive.
Yeah, but we also always want to remind you that, AI insights and these automated value estimates, they can absolutely be wrong.
Very true.
Always verify the data yourself. Never just take an AI's word for it. And just to be clear, we are not giving financial advice here, and we are not telling you to buy, sell, or hold anything. We are just looking at long-term wealth building and protecting your capital.
Absolutely. Do your own research.
Okay, so I want you to imagine for a second that you are driving down this completely deserted stretch of highway. You're, miles and miles from the nearest town. You reach for your phone to check your GPS, and you look down and you have 0 bars.
Oh, yeah, the classic dead zone. We have all been there.
Right. We all know that feeling. But I want you to imagine a future where those dead zones just simply do not exist anymore.
Which sounds kind of crazy.
It does, and not because telecom companies finally decided to spend decades fighting zoning boards to build physical towers out in the middle of nowhere, but because the cell towers themselves are actually floating in the vacuum of space.
I mean, honestly, it sounds like science fiction.
It totally does.
But the engineering required to actually pull that off, it is happening in real time right now. And I think more importantly for our wealth building discussion today, the capital required to build it is flowing right now.
Yeah, so welcome to this deep dive. Today we are exploring the wild frontier of the space economy, which is just exploding.
It really is.
We've got a fascinating stack of sources to go through today. We're looking at an evidence-led research report on a true first mover in this space, a company called AST SpaceMobile.
Right. Ticker symbol ASTS.
Exactly. And we're also looking at documentation on those AI-aided financial research platforms like StockOracle to help us understand how modern analysts even try to value these massive kind of binary outcome infrastructure bets.
Because valuing a company that is building an orbital network is fundamentally different from, say, valuing a traditional software company.
Oh, completely.
You are dealing with the literal laws of orbital mechanics, the heavy gravity of massive capital expenditures, and outcomes that basically range from a complete global monopoly all the way down to a rocket just exploding on a launch pad.
Which is terrifying for anyone focused on capital protection.
Right.
But whether you're an active investor or a tech enthusiast or just, someone who hates dropping calls, understanding the economics behind this specific space race is really crucial. The space economy saw a record $36 billion in investment in just the first quarter of 2026 alone.
That is just a staggering amount of money.
It is. And Goldman Sachs is projecting we are looking at a $1.8 trillion industry by 2035.
Wow.
So our mission today is to figure out how you evaluate a pre-profit company carrying that kind of weight. So let's start with the ambition itself.
Okay.
AST SpaceMobile is building a satellite constellation, but it is entirely focused on direct-to-smartphone cellular coverage.
Yeah, and that phrase, direct-to-smartphone, that is the entire linchpin of the thesis here.
Right, because usually you need a dish, right?
Exactly. Historically, satellite internet required specialized hardware. You needed a literal dish on your roof, like Starlink, or you needed one of those clunky satellite phones with the massive, thick antennas.
Yeah, those big brick phones.
Right. But AST SpaceMobile is building an infrastructure where the standard, completely unmodified smartphone already sitting in your pocket connects directly to a satellite in low Earth orbit.
See, but the physics of that, they just seem impossible to me.
They are definitely complex.
Because a satellite in low Earth orbit is moving at something like, 17,000 miles an hour?
Give or take, yeah.
So if my iPhone is designed to connect to a stationary metal tower just down the road, how on earth does it talk to a satellite moving faster than a bullet?
Well, this is where we get into the core engineering marvel of what they are doing. You have to overcome massive latency and something called the Doppler shift.
Okay, the Doppler shift. Break that down for me.
So when an object is moving towards you at high speed, the frequency of its signal compresses. When it moves away, the frequency stretches out.
Okay.
Think of how a police siren changes pitch as it drives past you. It goes from high to low.
Right.
Exactly. Your cell phone is simply not programmed to handle a cellular signal that is changing frequency like that. It assumes the tower is bolted to the ground.
So ASTS basically has to trick the phone.
That's a good way to put it. The heavy lifting is done entirely by the satellite. They are deploying the largest commercial communications arrays ever built in low Earth orbit. I mean, these things are massive.
Wow.
These satellites act like giant mirrors in the sky, and they use incredibly sophisticated software to pre-compensate for that Doppler shift and the latency.
So they alter the signal before it even gets to my phone.
Precisely. They alter it before it reaches your phone so that your standard iPhone or Android simply thinks it's talking to a totally normal cell tower a few miles away.
Okay. That is pretty incredible if it works. And the evidence shows this isn't just theoretical anymore, right?
Right.
Because they currently have 13 satellites actually up in orbit.
They do. It's a real existing engine for the business.
And to support the financial side, they have secured a massive $1.3 billion contracted backlog with sovereign customers. But I need to pause here and challenge that number because as someone who focuses on capital protection, I get very nervous around startup backlogs.
That is fair. Very fair.
I mean, a $1.3 billion backlog sounds amazing, but are these binding, ironclad contracts, or are they just handshakes with governments who can basically walk away if the tech glitches?
And that is the exact question institutional investors are asking right now. A backlog in this context usually consists of memorandums of understanding and preliminary service agreements.
So not hard cash yet.
Right.
Yeah.
Sovereign nations are reserving network capacity because things like national security and emergency communications, they demand it. But you are absolutely correct to point out the vulnerability here. That revenue does not actually materialize until the service is actively turned on and functioning reliably.
Which perfectly explains this massive disconnect we are seeing in the market right now.
Yeah, the stock chart has been wild.
It really has. The constellation is growing. They have actual hardware in space, and yet the stock recently traded around $68.65.
Right.
That is down roughly 49% from its 52-week high of over $133. I mean, it dropped over 23% in just a 13-week window.
It's been a rough quarter.
So if the fundamental business quality is there and the fleet is growing, why is the market treating them like they are failing?
Well, the market isn't necessarily saying the underlying technology is a failure. The market is aggressively repricing execution risk.
Okay, execution risk. Tell me more.
When a stock shoots up to $133, based largely on successful early tests, it is being priced for an immaculate, flawless future. It's being priced as if the entire constellation is already built and generating cash today.
Right, priced for perfection.
Exactly.
Yeah.
But as the months drag on, the reality of what we can call orbital unit economics really sets in. Investors look at the calendar and realize, oh, wait, this company still has to manufacture dozens of these massive satellites.
Which takes a long time.
It takes forever. And then they have to secure rides on rockets and honestly pray those rockets don't explode. The timeline from successful tests to actual recurring revenue is a multi-year gauntlet.
And that fear of the timeline brings us straight into the financial reality check, because the execution risk the market is so terrified of becomes painfully obvious when you look at how much cash it takes just to get to the starting line.
The cash burn is intense.
It is staggering. The sources lay out the financials, and for the full year of 2024, revenue was a mere $13.8 million.
Which is nothing for a telecom company.
Nothing. Now, in the second quarter of 2026, revenue jumped to $31.5 million, and they guided for $150 to $200 million for the full year, which sounds like a great hyper-growth tech company.
And a nice growth curve on the top line.
But then you look at the expenses. The net loss for the first half of 2026 was $421.9 million.
And honestly, net loss is just the tip of the iceberg here.
Really?
Oh, yeah. To truly understand the survival math of an infrastructure company like this, you have to look at the free cash flow proxy.
Okay, what is that?
That is operating cash flow minus capital expenditures. For the first half of 2026, that number was negative $1.004 billion.
Good grief.
Yeah. They burned through $1 billion in 6 months, largely driven by $859.2 million in CapEx.
I want to break down why that capital expenditure number is so high compared to building a regular telecom network. Because if I am Verizon or AT&T and I'm building a physical network, I buy some land, I pour concrete, put up a metal tower, and run fiber optic cables.
Right. It's expensive, but it's very predictable.
Exactly.
But with orbital infrastructure, the model is entirely front-loaded. you are doing aerospace manufacturing in clean rooms,
Yeah.
you are paying tens of millions of dollars just for the rocket fuel in the launch vehicle to put your tower into orbit.
Just to get it there.
Yes. And unlike a physical cell tower where you can start signing up customers the exact same day it's built, a satellite constellation requires a critical mass of satellites in orbit before you can offer a continuous, reliable service.
Right. Otherwise, the satellite passes over and then you have no signal for an hour until the next one shows up.
Exactly. You have to spend billions before you collect your first monthly subscription fee.
They aren't completely broke, though. The sources highlight that despite this cash furnace, ASTS has a massive pro forma liquidity of roughly $3.7 billion.
It is a massive war chest.
It is, but as a cautious investor, I have to point out where that cash came from. It came largely from a $1.15 billion convertible note offering in July of 2026.
Right.
A convertible note is essentially a loan that can turn into stock later on. So they bought themselves survival, but they introduced the threat of either massive stock dilution for current shareholders if the stock goes up, or crippling debt if they can't pay it back.
It is the ultimate double-edged sword. They now have nearly $3 billion in long-term debt on the balance sheet.
Which is terrifying.
It is, and this is why the valuation metrics require such careful scrutiny. The stock is currently trading at a price-to-sales ratio of 328x.
328 times sales.
Yes. That means for every single dollar of revenue the company brings in, investors are paying $328 for the stock. Combine that with a net margin of negative 573%, and you have a valuation that demands absolute perfection from management.
And this is where analyzing this company gets incredibly tricky for the average person. I mean, our sources detail how analysts try to use AI-aided financial research platforms, like StockOracle, to value a stock like ASTS.
Which can be really helpful but also dangerous.
Right. These platforms are great because they aggregate fundamental data. They can track up to 15,700 US and OTC securities, and they run these proprietary models to generate an intrinsic value.
What they call an OracleValue user.
Yeah, and they often use a discounted cash flow or DCF model to do it. But I have reservations about that.
You should. Applying a standard discounted cash flow model to a pre-profit space company is basically an exercise in futility.
Why is that?
Well, a DCF model works by looking at predictable future cash flows and discounting them back to today's value. It's like trying to calculate what an apartment building is worth based on 10 years of guaranteed rent checks.
But ASTS isn't an apartment building. It's basically a lottery ticket that might print billions in a decade, or it might be a smoldering crater next month.
Precisely. If the company fails, the terminal value is zero.
Right.
But if they succeed and achieve a global monopoly on satellite cellular data, the value is astronomical.
So the AI just guesses.
Well, an AI financial model takes those two extreme binary outcomes, averages them together, and spits out a middle ground number that is mathematically meaningless. It doesn't reflect reality at all.
That makes total sense.
Furthermore, these AI tools often rely on historical data, which can be delayed by 15 minutes or only updated at the end of the day. An AI mode analysis doesn't know if a vital regulatory ruling was just delayed or if a rocket engine failed a static fire test this morning.
So the research tools are great for aggregating data, building custom watch lists, and organizing all this chaos, but you just cannot outsource your critical thinking to an algorithm when the whisks are this binary.
Absolutely not. You have to look at the actual operational catalysts.
Right. So let's get into the catalyst roadmap. What exactly does ASTS have to do to survive that debt and justify a 328x valuation multiple? The sources outline a very specific roadmap, culminating in what they call the blue sky scenario.
Okay, so let's break down the catalysts. The immediate bottleneck, the near-term catalyst, is manufacturing.
Building actual satellite.
Yes. They have a facility in Midland, Texas, which is heavily incentivized with up to $66 million in performance bonuses over 30 years. The entire focus right now is scaling that facility's production cadence to 6 satellites per month.
So 6 a month is the target. Why is 6 the magic number?
Because of that density requirement we discussed earlier.
Ah, right, to stop the dropped calls.
Exactly. To prevent dropped calls and provide continuous service, you need a certain number of satellites passing overhead at any given moment. Their goal is to have 45 or more satellites in the air by early 2027. If they can crank out 6 a month, they hit that threshold.
And that density unlocks what we could call the emerging engine, right? The single most important medium-term catalyst, which is the 2026 beta service launch.
Yes, the beta launch is everything. This is the moment of truth. This is where they try to transition that $1.3 billion backlog into actual recurring cash flow.
Because if the beta launch works, it proves the Doppler shifting technology actually functions at a commercial scale, not just in a test environment.
Right. But if it drops calls or the latency is terrible, the market will punish them relentlessly.
It'll be a bloodbath for the stock price.
It really will.
Yeah.
But assuming the beta launch is successful, we then have to look at the long-term catalyst, the massive wild card in their strategy.
The optionality.
Yes, the optionality. And that is the Legato Spectrum Agreement. This is the key to unlocking the true blue sky scenario.
Let's break down Spectrum, because it's essentially the invisible real estate of telecommunications.
That's a great way to put it.
ASTS is trying to get clearance from the Federal Communications Commission, the FCC, to access up to 45 megahertz of spectrum from a company called Legato for over 80 years.
Which is a massive chunk of time.
It is, but why is this specific spectrum so valuable? Why do they need this exact invisible real estate?
It comes down to the physics of radio waves. Lower frequency spectrum, which is what we are talking about here with Legato, has longer wavelengths.
Okay.
Those longer waves are incredibly valuable because they can penetrate physical obstacles. They can travel through heavy rain, thick foliage, and most importantly, concrete buildings.
Oh, wow. So unlike high-frequency 5G, which gets blocked by everything.
Exactly. Higher frequencies carry more data, sure, but they get blocked by a stiff breeze or a pane of glass. Low frequency is robust.
So if the FCC approves this, ASTS isn't just getting random airwaves. They are securing exclusive rights to the best possible invisible real estate for 80 years across 96 satellites. That has to fundamentally change the business model, doesn't it?
It really does. It creates a virtually impenetrable structural moat. If they secure that spectrum, their unit economics were locked in for the rest of the century.
That is insane.
They transition from being a high-risk aerospace startup burning cash to a global infrastructure stronghold that is just compounding revenue. Ironically, if that happens, their valuation multiples would actually compress, even if the stock price goes up, because the underlying revenue would finally explode to match the hype.
Okay, but as the cautious voice here, the reality of researching the unknown means we have to look at what could go wrong, what breaks this thesis.
We definitely need to talk about the risks.
Because the path to that blue sky scenario is littered with existential threats. To me, the biggest threat, the primary thesis breaker, is the race against their own structural unprofitability.
The cash burn.
Exactly. They have $3.7 billion in liquidity today, sure, but they are burning $1 billion every 6 months. If that Midland facility hits a supply chain snag and they can only produce, say, 2 satellites a month instead of 6, the entire deployment timeline pushes to the right.
And when the timeline pushes right, the cash burns faster than the revenue can replace it.
Right, forcing them back into the debt markets or forcing them to dilute shareholders again. It's a vicious cycle that destroys capital.
Then you have to add the inherent risk of spaceflight. Launching payloads on rockets is not like putting boxes on a FedEx truck.
Rockets explode.
Rockets experience catastrophic anomalies, yes. If a launch vehicle carrying 4 weeks' worth of satellite production is lost, it is a devastating blow to both their financials and their timeline.
Not to mention the regulatory risk. The FCC could simply reject the Legato Spectrum deal entirely or tie it up in litigation for 5 years.
Which happens all the time in telecom.
It does. And if that happens, ASTS has to operate within a much narrower, less efficient spectrum band, which completely kneecaps that whole blue sky scenario.
It does. And honestly, you can actually see the market holding its breath on these risks right now when you look at the technical sentiment.
Right. The market leaves footprints. So what are the current technical indicators telling us?
Well, the sources note the stock is trading below both its 50-day and 200-day moving averages.
Which is pretty bearish.
For anyone tracking momentum, that is a classic signal of medium-term hesitation from institutional buyers.
But more revealing to me is the insider activity. The executives actually running the company have made 0 open market purchases recently.
None at all.
None. We only see a couple of sales totaling around 85,000 shares.
Interesting. Now, a lack of insider buying at heavily discounted levels doesn't necessarily mean the company is doomed, but it is a sobering reality check.
It definitely makes me pause.
Right. It signals that management is acutely aware of the binary hurdles ahead. They know the beta launch and the FCC rulings are not guaranteed.
Okay, so let's bring this all together. Let's look at the 3 to 5 year blue sky scenario first. And just to be completely clear, this is an optimistic scenario, not a prediction, and definitely not financial advice.
Right. But the blue sky scenario is that they execute perfectly. The 2026 beta launch is flawless. They get the FCC legato approval, and they achieve a true global monopoly on direct-to-smartphone cellular connectivity.
And because they are the only game in town with that spectrum, they have unprecedented margins. That's the dream.
That is the dream. That is how they compound shareholder value over the next decade.
But the base case, the more realistic outcome we have to weigh against that is that they struggle with manufacturing delays, maybe they suffer some launch setbacks, and they have to heavily dilute shareholders to service that $3 billion in debt just to survive.
Right. It is a fundamentally constructive outlook overall, but it is highly execution dependent. It is literally a dead sprint between a massive $3.7 billion liquidity runway and the crushing capital requirements of building an orbital network.
So when you pull all this complex evidence together, the groundbreaking Doppler shifting tech, the billion-dollar cash furnace, the FCC hurdles, the deep dive research gives AST SpaceMobile a 7 out of 10 rating.
Which feels fair, given the optionality.
It does. And this brings us back to why you, the listener, should care about this outcome, regardless of whether you ever trade a single share of space stock. We are witnessing a fundamental paradigm shift in human connectivity.
We really are. We are moving the hardest, most expensive, and most vulnerable parts of our communication network off the surface of the Earth entirely.
The transition from terrestrial cell towers anchored in the dirt to orbital networks painting the entire globe with an invisible, ubiquitous signal is happening above our heads right now.
It requires an iron stomach for financial risk, but the hardware is literally up there.
It is. So, real quick before we wrap up, don't forget to check out this StockOracle 14-day trial link in the description if you want to dig into the data yourself. Again, be mindful of the AI limitations, but it is a great research tool.
Definitely worth a look to build your watch lists.
And that leaves us with a final thought for you to explore on your own. If this direct-to-smartphone technology actually succeeds at scale, and sovereign nations begin relying on a single company's orbital infrastructure for their most basic cellular coverage.
How does that shift the balance of power among global telecom monopolies?
Exactly. And more profoundly, what happens to the concept of physical national borders when the internet simply falls from the sky everywhere all at once?
That is the trillion-dollar question that goes far beyond any balance sheet.
Thanks for diving deep with us.